What if the contractually guaranteed financial product you bought to completely secure your entire retirement is actually a sophisticated engine designed to quietly dismantle your wealth? Imagine stepping into early retirement, happily handing over your hard-earned 401k to an institution promising a flawless, contractually guaranteed 7% annual income stream. It feels like an absolute victory over Wall Street volatility, until you notice your fixed monthly paycheck buys significantly fewer everyday essentials every single year. Why do contractually guaranteed financial vehicles frequently leave cautious retirees significantly poorer than standard index fund investors over a realistic 10-year timeline? The shocking truth isn't sudden market performance, but a hidden structural calculation gap that converts your liquid wealth into an unchangeable, steadily depreciating asset stream. This systematic mechanism safely locks your core retirement principal behind a multi-year penalty barrier, leaving your real-world purchasing power entirely exposed to severe macroeconomic erosion. To unravel this institutional mechanism, we must first analyze the deliberate divergence between what marketers call a roll-up rate and your actual withdrawal limits. That phantom 7% compounding figure you see in bold print is a specialized accounting illusion used solely to determine your future lifetime income base. You cannot actually liquidate that 7% balance because your real-world cash distribution is strictly restricted to a rigid 4% or 5% based on your age. This creates the psychological phenomenon known as the golden velvet cage, where your contract appears incredibly secure and comfortable from a distance. Inside this cage, your digital statement looks massive due to automated tax-deferred accumulation visualizers designed to reinforce your continuous compliance. However, the exact moment life happens and you try to open that secure door to access emergency cash, the system alters its behavior entirely. You immediately trigger the Surrender Charge Sentry, a brutal contractual penalty mechanism that locks down your liquid capital with absolute institutional authority. This penalty operates on a strict multi-year descending scale, confiscating as much as 10% of your entire hard-earned principal for early liquidations. Simultaneously, you face the silent internal erosion of a 0.0% inflation adjustment mechanism, meaning your guaranteed nominal income never updates for rising costs. Your principal remains entirely immobilized, while macroeconomics continuously devalues the real-world utility of every single dollar distributed by the contract. Financial marketing systematically exploits your natural loss aversion bias, framing standard market corrections as an absolute existential enemy to alter your behavior. By amplifying your fear of volatility, they nudge you into signing incredibly lengthy, restrictive agreements while you remain blind to structural costs. You feel completely insulated from downside variance, unaware that cumulative lifetime income rider fees are actively draining your core portfolio capitalization. To truly defend your autonomy, you must decode the underlying asset management math before institutional sales frameworks permanently compromise your liquid capital. Upgrade your absolute financial defenses right now before the broader commercial system permanently immobilizes your hard-earned wealth accumulation assets. Hit that subscribe button this instant to unlock advanced behavioral money psychology breakdowns every single week and protect your real purchasing power. By joining our global community, you will gain the exact algorithmic intelligence required to bypass sophisticated institutional marketing traps safely. Do not let deceptive numeric guarantees compromise your future liquid freedom, because true financial security requires uncompromised capital mobility. Let us look at a brutal, real-world $1 million retirement portfolio showdown to see exactly how much money these rigid structures cost you over time. Imagine two investors starting at the exact same starting line, each possessing a $1 million nest egg for a 15-year timeline. Profile A chooses the psychological safety of a fixed indexed annuity with a guaranteed income rider, yielding a perfectly flat $50,000 annual payout. Profile B utilizes a dynamic 4% withdrawal strategy from a diversified, low-fee index fund portfolio, fully embracing standard macroeconomic volatility for long-term growth. During the first 3 years, Profile A feels incredibly smart, as their nominal $50,000 distribution arrives precisely on time, regardless of market conditions. When brief market corrections occur, Profile B sees their digital balance fluctuate, but their algorithmic withdrawal strategy smoothly adjusts without triggering emotional panic. However, the mathematical narrative violently shifts as we cross the 10-year horizon and introduce the unavoidable compounding variable of systemic macroeconomic inflation. Profile A's fixed $50,000 payout is completely frozen, while a silent swarm of cumulative 3% annual rider fees aggressively devours their underlying principal. Because their contract lacks any functional inflation adjustment mechanism, their real-world purchasing power suffers a massive 35% reduction at the everyday grocery store. Their golden velvet cage has successfully immobilized their capital, converting a seemingly flawless guarantee into a guaranteed reduction of their standard of living. Meanwhile, Profile B experiences the exact opposite phenomenon, using compound asset growth to systematically outpace the rising costs of essential consumer goods. Despite enduring natural market corrections, their diversified equity engine acts as an aggressive barrier, actively expanding their real purchasing power over a decade. Looking at the side-by-side comparison matrix, the illusion completely shatters, revealing that absolute numerical certainty often mathematically guarantees severe long-term financial depletion. The Surrender Charge Sentry keeps Profile A permanently trapped in this depreciating cycle, heavily penalizing any desperate attempt to rescue their remaining liquidity. To survive the modern macroeconomic environment, you must permanently stop trading your foundational liquidity for an incredibly expensive and restrictive psychological comfort blanket. Instead of surrendering your core wealth to insurance institutions, it is time to build an algorithmic cash flow engine that completely eliminates middlemen. Welcome to the ultimate actionable financial brain hack for modern retirees. A structural environment control skill mathematically known as the Hybrid Liquidity Ladder. Instead of signing over 100% of your foundational capital to a rigid contract, you strategically divide your assets to serve two distinctly different timelines. First, you construct a secure 3-year immediate cash buffer using rolling, low-fee Treasury bills, securing your short-term lifestyle without any massive institutional lockups. This ultra-safe, highly liquid buffer completely isolates your daily emotional state from sudden stock market fluctuations, perfectly replicating the psychological safety of an annuity. Second, you allocate your remaining foundational capital into automated, broad-market equity index funds, specifically optimized for aggressive, long-term macroeconomic inflation matching and growth. This algorithmic separation completely eliminates expensive rider fees, while ensuring your core portfolio aggressively compounds to protect your purchasing power decades into retirement. Before you step into your next scheduled meeting with a commissioned financial planner tomorrow morning, you need to execute one critical defensive audit. Pull out your current retirement portfolio statements and manually locate the hidden lines labeled Surrender Charge Schedule and Lifetime Income Rider Fee. Calculate exactly how much actual principal you lose over the next decade, just to maintain the psychological illusion of a guaranteed fixed payout. Take back total control of your foundational assets, destroy the golden velvet cage, and engineer a retirement powered by uncompromised, highly liquid mathematical truth.